Two quality stocks trading at fair value. This is a video that I do every month talking about two quality stocks or undervalued stocks. And I have to say, I'm getting very excited about this. You could call it pullback. It's like 1 or 2%. But I'm starting to see some opportunities at 52 weeks lows, or a lot of the big tech stocks, they're starting to sell off a little bit. It's getting very encouraging. And we really need more of that stuff. And I hope it continues to happen, maybe into the elections due to uncertainty and stocks being priced to perfection. Because as a long-term investor, you really want those pullbacks, because your stocks or your companies, they get to buy back more stocks at lower prices. You get to also buy the dip on some stocks. And it's better for a longer-term rally. It's better to have certain pullbacks so we could have a sustainable rally. And based on the latest fundamentals and valuations, it just wasn't set up for any sustainable long-term rally. And I hope it continues going down. And I'm starting to find some opportunities. The first one is a popular one. The second one is a stock that I call it my easy money stock, because it's very predictable. It goes up and down on the same kind of price range. It's very predictable dividend stock, and it's also a good long-term investor. So I really hope you enjoy it. The first one is Microsoft. Microsoft is down close to 6% today, and it might surprise a lot of you because many people believe that Microsoft is extremely overvalued, and I believe it's getting very close to fair value. It's not at fair value yet. It's very, very close, but I have to talk about it because it's getting there, and we might get there by the elections. You never know. Due to uncertainty, maybe higher taxes, maybe higher tariffs, we don't know. The market freaks out and maybe it continues going down. And it would be an amazing opportunity. But for Microsoft, they did very well on earnings. They did a decent beat on earnings per share, decent beat on revenues. It was a good, report in general. The main reason why Microsoft went down is because they guided 68.1 to 69.1 for guidance. And the analysts, they were expecting 69.8. So this is like $1 billion miss, or even less, like maybe $700 million miss on the high end, which is really nothing for Microsoft. It's still 10.6% growth. This is amazing for a $3 trillion company, with Azure growing like 34 or 35%. It was an amazing report. But the stock was priced to perfection. And whenever you have your stock priced to perfection, any little miss, any little disappointment could cause a massive reaction to the downside. And this is, very normal, very predictable. I'm trying to keep this video short, but most of you know how Microsoft makes their money. You have Microsoft 365, LinkedIn, that's like 43%. Then you have Azure and others, 37%. Then you have Windows and personal computing, which isn't the best segment of Microsoft, but it's still around 20% of revenues. If we look at the price to earnings ratio of Microsoft, it's still trading at 32 times earnings, but this is without today's pullbacks. With today's pullback, maybe it's like 31 times, because it takes a few minutes to adjust, but I would say around 31 times. Now, if you look over the last 10 years and you're checking, for example, 31 times earnings, you would see that it's much higher than the historical average. The mean was like 26 times. And before that, in 2016, 17, it used to trade at 21, 22 times. So a lot of people make the mistake of looking at Microsoft and they say, oh, it's at 30 times earnings. It used to trade at 25. It's extremely overvalued. But this is not really the case, and I don't believe it's a fair comparison. Because now, yes, Microsoft is trading around 30 times earnings, which is much higher than what it traded at in 2016, 2017. But now Microsoft has much higher return on capital than it had in 2016. It went from 15% to 30%, more than a double in the return on capital of Microsoft. You could look at the net income margin of Microsoft. In 2016, 2015, when it was trading at 22 times earnings, Microsoft had a 23% net income margin. Now the stock was trading at 30 times earnings, but the net income margin is 36%, almost 36% net income margin. So it's a really bad idea to compare Microsoft today to what Microsoft was, let's say, in 2016, and say Microsoft at 30 times earnings is extremely overvalued. It's not undervalued by any means, but it's closer to fairly valued than it is on the overvalued side. And it did go 21, 22 times in 2022, but I mean, I really doubt we're gonna have another 2022 again anytime soon, just being honest. But I want to keep this video short, and I'm going to give you my valuation model on Microsoft. I put in 15% over the next 5 years in terms of revenue growth. I think it's highly achievable. And the analysts are also putting up around 15% average, 14, 15%. I think this is very possible. It's very, very possible. Net income margin, I kept it at 36%. As I said, the stock right now is trading around 30 times earnings, but I put in 27 times to illustrate a point. Okay, and 27 times does price in a multiple contraction in case Microsoft gets a lower multiple 5 years from now, which I personally doubt because the company has been becoming more profitable over time. You have OpenAI, a lot of the AI tailwinds that you have right now that could be massive, profit machines for a company like Microsoft. So I highly doubt the net income margin is going to be, lower, or the P is going to be lower. I think both are going to be much, much higher. But I did take this into account, putting in 27 times earnings. And I put in a shareholder yield of 2.4%, which takes into consideration some buybacks and dividends. In total, I would get 72% on the upside, or 12.2% CAGR over the next 5 years with Microsoft, which I personally believe is not really a bad return, especially as you're taking in, you could say, some kind of margin of safety of 27 times earnings. Now, what I think will happen, I think Microsoft will likely be trading at 30 times earnings 5 years from now. Just the same multiple as it is at today, maybe a little bit lower. Now, if it does trade at 30 times earnings 5 years from now, then your upside from here is around 89%, or 14.6% CAGR over the next 5 years. And if you want to double your money with Microsoft over the next 5 years, you would have to buy it around $382 per share. So the way I look at Microsoft for the risk-reward setup, means the risks that I'm taking with Microsoft, this amazing company, wide moat, the AI tailwinds, and a good balance sheet, and just good free cash flow, wide, massive businesses, amazing stuff, and have the potential to get around 15% a year. That doesn't happen very often. It happens with smaller stocks, mid-cap stocks, but with mega-cap stocks with such amazing quality, it's very hard to get 14 to 15%. So I like Microsoft very much over here, but for me personally, if I want to own Microsoft, I would be trying to get some kind of margin of safety. If it does go to 27 times, I would have to buy it around 350 to get it double. So for me personally, I have a buy alert on Microsoft around 375. So if it gets to 375, I get notified that Microsoft hits 375. Then I can double check it and look at everything, and maybe I consider buying the stock. So it's getting very, very close to undervalued territories, in my opinion. At 408, it's fairly valued and could return 13 to 14% over the next 5 years, which is very rare for a company like Microsoft. And that's why I talked about it in this video, because it's getting very, very interesting. And we might get there to 375 by elections if it continues going down due to uncertainty. I wouldn't be surprised at all. And this is, the first one. The second one, which I call my easy money stock, and it doesn't mean you can't lose money, I have to be clear, but it's pretty hard to do so. And this is a stock called Pepsi. Pepsi is down 3.5% over the last 5 days. Pepsi is a very predictable stock if you're a trader. Even on the long term, it's an amazing company, but if you're a trader or you like doing stuff for the short term, Pepsi is very predictable. It goes to 162, 163. It's hard to lose money buying it there. It bounced many times, and I did that many times, and I sold it 180s and buy back in 160s. It's very predictable. But if you 162, 163, it goes there normally. It rarely goes lower. Then it goes up to 180, 182. Then it goes back to 160. Then it goes back to 180. And it's been the same pattern since pretty much late 2021 to early 2022. So over the last 2 years, you could have done this trade and made, 14, 15% per trade. And this trade is available every 3-4 months. And it's been very predictable, very easy stuff. And now it's happening again, and it's sitting at $166 per share, which I believe is undervalued for a company like Pepsi. But even over the long term, I like Pepsi very much more than Coke, not just because of the valuation, but I like Pepsi's exposure into convenient food and snacks, which is 59%. Coke is more focused on beverages. Pepsi is more diversified. And I like being diversified with that stuff. Now, the main problem with Pepsi and most food companies is they are experiencing massive declines in volume, especially Hershey's. Hershey's is really bad. and there's others too. But Pepsi is also somewhat experiencing the same things in certain countries. But the best part about companies like Pepsi and Coke is they have the pricing power to raise prices and offset the decrease in volume. Now, the main arguments from the bears were that, they just can't keep doing it forever. Also, Pepsi has been doing it for like 40 years. But people always say, oh, yeah, you just can't keep raising prices forever. And I've been hearing that since 2021. And they did raise prices, and they are right now. And they will likely continue to raise prices because they have the pricing power to do so. It's just an amazing business model in general. And despite, some decreasing in volume and many different things, Pepsi was still able to grow 5% in EPS this quarter and around 7% year to date, which is all you need for Pepsi to make sense. I'm going to explain. For the dividend, it's around 3%, 3.3%. A lot of you like the dividend, and they've been paying it for 52 years, growing at a 7.7% CAGR. So it's a very safe payout ratio, and they've been growing it. And it's a good company for the long term in general, especially for dividend investors. But if you look at this chart of the PE ratio or forward PE ratio of Pepsi, it's trading at 19.5 times earnings. 19.5 times earnings, if you look at it over the last 10 years, it has historically been a good time to be buying Pepsi. If you look at this line, there was many times where Pepsi bottomed around 19.5, and then it went up from there. And it's historically been a good time to be buying Pepsi, around 19.5 times earnings. The lowest it went to was around 17 times, and that was, I believe, in 2018 and in March 2020. And now you're buying it at 19.5 with a mean of 22 times, and it traded as high as 27 times earnings. So just looking at this multiple alone, it has historically been a good time to be buying Pepsi. But in terms of me valuing it over the next 5 years, I look at the company's own guidance, and I believe it's very fair and it's very achievable because they've been raising prices to meet this guidance. And their guidance is 4 to 6% of revenue growth, organic growth. But they also buy back 1-2% of the market cap per year. So earnings per share guidance is high single digits, which is likely around 8 to 9% of earnings per share growth. I'm taking 8% for this video, and I think it's very fair. And the way I did it, it's a very simple calculation. I put in the current earnings per share, which is 8.15. Then I put in 5 years on an 8% interest rate, which is a growth rate. In total, I got $11.98 of EPS, which is for 2029. It's just 5 years from now, 2029. And it's $11.98. Okay. Now we looked at the multiple, and it's now trading at 19.5. The mean was around 22.5. And over the next 5 years, I wouldn't be surprised if Pepsi reverts back to the mean of 22.5, because it's not just because the company isn't growing as much. It was never really a major growth company. But the main reason it's not trading at this level, in my opinion, is because of the market. The market is more of a risk-on rally at the moment, or maybe a few weeks ago. It's more about AI and tech stocks and exciting stocks, not much about boring stocks, because you could notice this trend with Nike, notice it with Pepsi, you could notice it with Coke, you could notice it with, I believe, Johnson & Johnson, Hershey's. A lot of those stocks are way down, and they're much lower than their mean multiple because the market isn't really favoring safety stocks too much. But once this, AI rally is cooling off or it goes down, I wouldn't be surprised if Pepsi gets back to 22 times. So if I take this earnings per share estimate of 11.98, and I take in 11.98 and I time it by 22.5 times earnings, assuming it gets back to the mean multiple over the next 5 years, which isn't unreasonable, I would get around $269 per share over the next 5 years for a price for Pepsi, and then I divide it by the current price of $166 per share, I would get around 62% on the upside over the next 5 years with a company like Pepsi, and you still have like a 3.3% dividend over the next 5 years. That's like an extra 15% total, maybe closer to 80%. So that's around 77% to 80% return over the next 5 years with a safe company like Pepsi. And again, that's why I included those stocks, because they don't have the highest return. But if you look at the risk that you're taking for the rewards that you're getting, it's an amazing risk-reward setup. For Pepsi, I'm seeing pretty close to 80%. For Microsoft, I am also seeing 80% over the next 5 years. And if it does get to my price of $375, then we could see pretty close to 100%. And this is not with some kind of a shit company. This is with an amazing company like Microsoft, which is isn't an opportunity that you find very often. So that's why I like Microsoft very much. I like Pepsi very much. I hope it continues to go down so we can get these companies at an undervalued price instead of a fairly valued price. It would be much better. But this is what I have for today. Thank you for watching. Not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.